Hello everyone. This week we will be going over Chapter 6, our financial markets efficient. This should be fairly quick here because there aren't really any problems to work through. It starts off talking about the efficient market hypothesis, which I'm guessing you all have heard of before. So the basic definition of that is that prices reflect all current available information. And this relies on an assumption of rationality. So the book doesn't say this directly, but it assumes that all investors act rationally. And if any of you have taken any economics courses, this means that they always make the right decision essentially to maximize their lifetime utility. So the book shows here that this ensures that the expected return here equals the equilibrium, what they call the equilibrium return, whatever that is, which we'll see in a little bit is just the mean. So the rationale behind this is that even if we allow for some investors to be irrational and essentially make the wrong decisions for themselves, there will be arbitrageurs who will essentially correct this mistake. So let's assume that I am irrational and I buy a bunch of Apple stock, and that causes it to be overpriced. Somebody else recognizing that who is rational will simply short sell that stock until the price will tend towards equilibrium. So it essentially removes any sort of mispricing in the market. Where an arbitrage, and again, I assume you've all heard of this before, is a riskless guaranteed profits, where so a standard way to do this would be to identify a stock as overpriced and short sell that one, which means you get funds today, and use those funds to buy an underpriced stock. So you don't have to put up any of your own money up front, and there's no risk involved. So some of the evidence, or actually let me get to they talk about random walk. So because the market is, or if the market is efficient, if the efficient market hypothesis holds, then prices and following prices, of course, returns should be completely unpredictable, or they should follow what it calls a random walk. So a random walk, a simple version of this is if you look at this equation here. So essentially it is next period's or today's time t's expected return equals yesterday's expected return plus some error, where this error here is what white noise, which means it's just completely random. So if you look at this graph here, the green is essentially just that random piece where it's a random walk. You don't know where it's going. And the equilibrium, what they call in the book here, should equal the mean of that, or the expectation of that, which is just the mean, which will equal this expected return. So essentially, given that all these fluctuations here that you see on the graph, given that they're random, the best guess that you have of the expected return is just simply the mean. So next they talk about technical analysis. So generally speaking, there are two different ways that traders try to make a living, essentially trading stocks, and that is technical or fundamental analysis, where technical is they're only looking at the past information of the stock price. So this random walk, or a model something like this where there's time t and time t minus 1, that would be like a technical analysis, or they look for patterns. Sometimes you see on finance channels or stock programs that they notice this pattern, or they notice that 3 weeks in a row the stock price did this or that. But the important part is that the only input to predicting where the return goes is based on past movements, where fundamental analysis is based on like accounting details. So like profit ratios, dividends, things like that. So a little bit of evidence against market efficiency. So generally speaking, the field that pushes against the efficient market hypothesis is known as behavioral finance. And this is actually my area of interest. So I think this is interesting. And if you all do, you can look up researchers. The first one is Daniel Kahneman. The next one is Robert Shiller and Richard Thaler. I believe they have all won Nobel Prizes now for their work, where Daniel Kahneman was actually a psychologist. So he did a lot of work studying irrationality or bias. And that sort of laid a foundation for Shiller and Thaler and others, of course, to study behavioral finance, which assumes that investors are rational and wonder what effect this has on the market. So from the book, they talk about a few specifics of evidence against the efficient market hypothesis. The first is the small firm effect. Basically, this is an empirical finding that small firms tend to out-earn the big firms. And actually, this is something that was found by two men named Eugene Fama and Kenneth French, which they are actually like the biggest proponents of the efficient market hypothesis. So I do find it kind of curious that they have this in this section. So again, if you're more interested in the efficient market hypothesis, you can perhaps research those two. They're probably the most famous researchers in asset pricing. So the next is market overreaction, or a lot of times in the literature, this is known as investor sentiment. So Richard Thaler and Robert Shiller do a lot of work here. So it's just basically the idea that investors overreact to good or bad news. So we can even think of something like Tesla in the last couple months the stock price has skyrocketed. So it's basically argues there can be sort of a snowball effect of when good news happens, people overreact to that. Or we can even think about something that, like if Donald Trump tweets about a firm and their stock price goes down like 20% in a day, obviously that has nothing to do with the fundamentals of that firm changing. It's just perhaps the market overreacting to that. And next, they talk about excessive volatility. So actually, this is the reason why Robert Shiller won his Nobel Prize. In 1981, he had a paper that essentially argued the actual prices that are observed do not reflect the fundamentals. So a simple model here where the price today should equal the sum of the expected value of future dividends all the way into the future. So time t plus I so it should equal the discounted cash flows essentially, which I'm sure you've all heard of, divided by 1 plus some discount rate, which should represent investors' appetite for risk. So if you look up that paper, he essentially shows a graph like this, where the dividends or the fundamentals are much, much smoother than the price. So all of these huge fluctuations of the green line in relation to the orange, that is essentially his argument that there's way too much volatility that doesn't reflect the changes in the actual fundamentals across time. And this is not in the book, but again, if you all are interested in this, so Fama and French would argue that instead, so in Schiller's paper, he assumes that this discount rate is fixed. So investors' aggregate level of basically their risk, the amount of risk they're willing to take on is constant over time. But Fama and French argue that this is actually probably time varying. So the reason that you would see these big swings here in this green line would be because investors' discount rate is fluctuating. So like perhaps before the housing crisis, it was the stock market was doing very well, so perhaps investors were willing to take on more risk. But then once the bubble burst and the stock market tanked, in general, people are not willing to take on that risk and they want to move their money to safer assets. So that would just be one example. Next, they talk about mean reversion. Sometimes this is called reversal. And again, it's just an empirical fact that researchers have noticed over time that stock prices tend to move back to their mean. And Richard Thaler does a lot of work with this, and he talks about winners and losers, where he shows that past winners tend to be future losers and past losers tend to be future winners. So that's the idea of this mean reversion. Also, so this is not in here either, but it does have to do with the idea of arbitrage, and that's why the efficient market hypothesis would hold. So Richard Thaler does a lot of work with limits to arbitrage. So he essentially argues that there are frictions within the market that don't allow people to perfectly arbitrage, like short selling. There's cost to doing that. There's cost to gathering information and things like that. So this would be an argument that against the arbitrage. So he would say, hey, the market's inefficient. And then somebody like Fama French would say, actually, it is efficient because people would arbitrage away any inefficiencies. And then Thaler comes back to that and says, no, well, there's these limits to arbitrage, which would keep mispricing persistent. So again, this is a pretty quick chapter. There's no real quantitative problems to go over. So they end talking about investment strategy. So obviously I'm not giving you all any advice to follow, just talking a little bit about what the book goes over. Like they ask, should you be skeptical of hot tips and things like that, which I believe, yes, you should. So the efficient market hypothesis, of course, argues that prices are completely unpredictable, which is sort of curious because we know that, first of all, researchers in asset pricing, that's what they do. They try to show what does explain stock returns or stock prices. And also, of course, there's a huge competitive market of investment banks and things like that, like Fidelity and things like that, that's what they do. They invest your money for you. Think like 401ks and things like that. So in general, there are active and passive funds, where active is when there is a physical person making decisions on the behalf of your money, where they're buying and selling stocks. And then there's passive fund, and they take a commission for that. And there's passive funds, which there isn't really a physical human being making those decisions. It just follows like a market index. And because of that, they don't take a commission. So those are cheaper. And there is a theory that the passive fund is better because the market is close to efficient because it's so competitive. And the fees for those sorts of funds are much lower. However, this relies on the fact that there's so many active funds. So the reason it's perhaps what they call like strong form efficient is because there are so many active funds out there trying to arbitrage, essentially, or trying to make money and predict what the future stock prices are going to be. So that's all I had. Again, if you all have any questions, please let me know.